You're listening to Breakaway Wealth, the show designed to help you build wealth faster, think bigger, and break out of the herd. Now, here's your host, Jim Oliver. Before we jump into today's show, we have some exciting news to share with you. Our brand new online community platform is now live. Get access to free on-demand, in-depth training courses on topics like infinite banking, cryptocurrency, real estate investing, and much more. Just go to community.createtailwind.com. That's community.createtailwind.com, or check out the show notes of this episode to find the direct link to request to join the community. Now, on to the show.
Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, Chris Younger. Welcome, Chris.
Thanks so much, Jim. Appreciate it.
Chris, you're from an area that's dear to my heart, Colorado, and my son lives in Centennial, so not too far from where you're at. But I miss the food in Colorado, and it's kind of weird. But one of the things that I miss is the cherry cricket. Remember the green chili there on a cold winter day. And, I know there's a secret that it's not that cold in the winter in Colorado, but we won't
tell anybody. Yeah.
It's kind of like Florida. Now I live in Florida, Chris, and I tell people, it's way too hot in the summer here. You would not enjoy it. I mean, there's nobody at the beach. I mean, you just wouldn't like it. But by the way, it's a lot more humid than in Colorado, but Colorado summers are pretty good.
Colorado
All right, Chris,
summers
tell
are
everybody
good.
about yourself, what you're doing, and then we'll dive in.
Perfect. Well, thanks, Jim. I appreciate it and appreciate you having me on. So I'm the CEO and co-founder of it's a financial services firm here in Denver. So we've got three pieces to our business. We have the core of it is an investment bank. So we help entrepreneurs get liquidity on their business, whether that's to sell their business or recapitalize it. Sometimes we'll help them raise money or do acquisitions. We also have on the back end, a family office. We have about 90 families. We manage about $1 billion for them. And almost all of them have been through our investment bank at some level. And then we have a group we call Pathfinder, which is really to give business owners guidance before they go to market, maybe a year to 5 years before they're going to market, on kind of how to optimize value and make sure that they can kind of see the test before they take it. So we'll work with 30 or 40 companies a year on the Pathfinder program. We'll do 15 or 20 deals a year in the bank. And then again, we hope to be able to continue working with those clients through the family office, which for us kind of checks our core three values are hustle, humility, and relationships. And so being able to keep those clients on through the family office, at least it allows us to honor that third value in a way that's meaningful.
I love that hustle, humility, and relationships. I think that echoes a lot of things, a lot of the important keys to being successful. And one of the ones that I think is lost on a lot of people is humility. Everybody wants to tell you how great they are and everything else. But what I really like about what you said is, when I first read your information that was in my calendar, I said, why am I having a financial advisor on my show? Because I'm normally, like, I don't want to say anti-Wall Street, but I'm anti-Edward Jones and these guys that are just money babysitters that aren't doing anything. They're just getting paid to acquire assets and get assets under management, and then they're really not doing anything. They're like middlemen, but they're not providing value. And so I am anti that because I think it's lazy and I think it's not the way that people make money, especially business owners like you mentioned. We have a lot of business owners in the audience. I own over 30 businesses or parts of 30 businesses myself, and I believe in business ownership. And I'll tell you a quick story because you'll appreciate this with Denver. So when I first got started in the business, I got started as a fee-based financial planner. So that's why I'm anti that.
Yeah,
it's because I know what it means, right? And I did it for 15 years coming out of college. I didn't know any better. And I thought, this is how people make money. But my market, everybody was going after the doctors, the accountants, the attorneys, and they were, and this is back in the 80s. So it was like, you had to have the right shoes, you had to have the right suit, the right tie, all that crap, right? And that none of us wear anymore, thank God. And I was like, this just isn't my vibe. So I went down and I was driving down Santa Fe Boulevard, and I saw these like little welding shops, plastics formation place, businesses. And I thought, these are my people in jeans. And, and I started working in that market, Chris, and I blew away everybody else in the office that was going after the shiny, high profile executives. And I loved it. My clients were in, ripped t-shirts and, and jeans and tennis shoes. And they, I had to change when I would leave the office, because back in those days we were required to wear a suit. But I love the family office concept too. And there's a lot of business owners out there, and they don't know what their exit strategy is. And there's nobody that their CPA isn't going to help them with their exit strategy. Nobody really sometimes knows what is the goal of owning this business, right? So talk about like what you've seen in your experience, and like kind of, maybe speak directly to some of those business owners out there, like that are thinking, I don't know how the heck this ends.
Well, it's a great question, and it is one that a lot of business owners struggle with for a bunch of different reasons. One is, where they've been running their business for 30 years, the whole plan to exit and then the exit process, they've never done. So it's not, at some level, I think it's natural for all of us, right, to avoid some of those things that we're not that comfortable with. I think the second piece is that a lot of business owners, myself included, we gain a lot of our identity through our business. And as much as we would love to say, yeah, you should separate work and, kind of this whole work-life balance, I think for most entrepreneurs, their work is so integrated into their life and into their identity, into what's important to them, that the notion of, hey, I'm going to move past this, I think it can be pretty daunting for them, and confusing, and create some anxiety for them. So it's not surprising to me that a lot of business owners don't necessarily spend a lot of time on this. But as I always tell clients, you're going to exit your business. It's your choice whether it's horizontally or vertically.
Yeah.
And so really the plan is, how do you plan for that in a way that's going to not only serve you as the owner of that asset, but also take care of the people that are important to you, your team, your customers, the reputation of your business. And in order to do that, you do have to put a plan together. You've got to be thoughtful about it. People always ask me, hey, when should somebody start thinking about exiting? I think in terms of the actual planning, it's probably 3 to 5 years is great. In terms of the building your business to be saleable, that should be forever. That should happen today, right? In terms of, because I do believe that if you can build a business that's saleable, that really means that business is scalable and is, can serve you as a business owner, whether you're working in it or not. And so that's the real planning that needs to go on for that business owner, and that's the thing that we encourage.
So I think that you just brought up something that's interesting, is you said if you're working in it or not. So like if you are an absentee owner, then, like your 3 to 5 years, and like you said, you're figuring out, how am I going to maximize value? How am I going to, who am I going to sell it to? Am I going to sell it to just, a competitor? Is a VC going to come in and give me a bunch of money? And you got to be careful with that, by the way, because I've seen that not work out a lot.
Sure.
But or if you're working in that business, then whoever buys it might want you to stay for a year, 2 years, 3 years, whatever it is. And you got to plan for that, because I see business owners get kind of caught flat-footed, not planning for that.
Yeah, I always tell our clients, it's really in your best interest to plan to work in the business for another couple years
Yeah.
past the sale for a bunch of different reasons. One, and selfishly for them, it will make the business more valuable to a buyer. If there's going to be a flash cut, even if you're an absentee owner, most buyers are, they'll be skeptical of any claims from a business owner that they're not that involved in the business.
Right.
They've been burnt too many times by that. So from a buyer's perspective, the notion that the owner is going to stay on and help make that transition smooth, that decreases risk. And everybody knows that the analog to decrease risk in an investment is increased value. And so they're going to value that business more highly than if the owner is planning to leave. In fact, there are a lot of investors out there that if the owner says, yeah, my plan is to leave, day one after the sale, they're not interested, just
Right.
because they know how risky that is. And
Yeah.
so I think the other piece, in addition to making the business more valuable, for most of our clients, they care deeply about their team. They care deeply about their customers. They care deeply about the reputation of their company in the community. And because they care so much about that, they're going to be best served by staying on to also smooth that transition and make sure that all those constituents and their reputation is protected. And the best way to do that is to be involved and to be part of that transition. And it's not to say that the business owner is going to last for 2 years. We have a lot of clients who don't, but you should plan on it, and you should plan on communicating that to the buyer that, hey, this is something that I'm committed to, and for all the right reasons. It's not to say, right, that a buyer and the business owner at some point aren't going to come to a different agreement, maybe sooner than 2 years, but at least plan on that.
Yeah, I like that. That makes, and again, it's not what we know that trips us up. It's what we don't know,
For
right?
sure.
And so, like, who's buying businesses right now? Is it like you said, investors? I always think that if I were a 20-something-year-old or a 30-something-year-old, I'm looking for a business that I can buy, that I can build, that I can scale. And, if I got real lucky, maybe I can get the owner to seller finance part of it, or, I could get creative. Depends on obviously the size of the business. Those are typically smaller businesses, but, is it VCs? Are they consolidating still, or is that trend kind of going away? What's going on out there in the market?
Yeah, it's a great question. For our business, our average deal size is about 70 million, and so it's typically going to be bigger than an
Yeah.
individual buyer could manage. But what we see today in the market, obviously interest rates having gone up quite a bit, have had an impact on private equity firms, which is the buyer of a good chunk of our clients' businesses.
Yeah.
We saw that market seize up a little bit in Q4 of 22. It's loosened up now. I think people have come to the realization that, yeah, the Fed rate at 0% was an anomaly, and 5% actually is probably more normal.
Yeah.
And so, that's definitely impacted valuations. We've seen valuations contract a little bit, but the deal activity has picked up quite a bit. So our clients typically, probably 60% of those are purchased by private equity firms.
Yeah.
And, those are firms that have raised money from institutions to go out and buy companies. And then the other 40% are they're strategic buyers, we call them, or buyers that are in and around our clients' industries, that have been the active buyers. And, we've got record amounts of cash on the balance sheets of large corporations. We've got record amounts of private equity that we call dry powder. The financing world, the debt financing world has changed quite a bit. 10 years ago, I would say, 80% of deals were financed with bank debt. So that's your local bank or, Bank of America, whatever. Today, it's about 80% of the deals are done by private credit. And these are just like private equity funds, only instead of investing in equity, they're investing in debt. And, those deals they're more flexible for the acquirer, for the buyer, for the private equity firm. They typically are a little bit more expensive, but they've definitely loosened up the market quite a bit and made, whereas historically, if banks quit lending, that would seize up the capital markets. We haven't seen that as much, just because people are looking for returns and places to put their capital.
which is cool. I mean, I think that having that alternative and not having just the, like you said, whether it's the local bank or big national bank, kind of dictating that market is cool. Like one of the things that I look at, and I think that people need a firm like yours is and I'll give you an example. I saw a business. I actually bought a small business from this business. But they had a small subsidiary that didn't really fit into their business model, but they got a $50 million VC infusion. And the guys on the board from the VC were like, well, why is this little company in there? And so it was good timing. Everything worked out well for me. But this company, the guys that I knew that founded this bigger company that was maybe worth 100, maybe, somewhere they thought it was like 150, but it was really around 100 million, is the VC came in, and the way that the agreement was written is the VC stock was going to be valued differently. I mean, like they were going to get their money first, I guess is what I'm trying to say to make it simple, right? They're going to get their money first. Then when everybody thought they're going to get rich on their stock, it was a totally different situation. And I think that that's where you need a guide to say, hey guys, you have some problems here.
Yeah, for sure. Capital structures can be complex, and if you're not savvy and you haven't been paying attention, you can lose a lot of money as a founder. Just in terms of what you're referring to, we call a liquidation preference.
Yeah.
And sometimes those firms not only get their money back, they get their money back times 3 before anyone else starts to participate. Yeah. And that can be really damaging for a business, and certainly for the common shareholders that were holding shares before the venture firm came in. But it is, I always tell people, look, these are extraordinarily important transactions, whether you're raising capital or you're going to sell the business. You definitely want expertise on your side, because I can guarantee you the folks on the other side have a lot of expertise.
Yeah.
It's like, if you were going to go play match play against Tiger Woods, you're likely to get your clock cleaned. And it's no different here. I mean, these folks are professionals, and they've been in the game a long time. And so obviously that's the role that we and other folks like us play, is to, help protect the entrepreneur.
So, it's funny about that, again, going back to this example, just again to buy this little, and I was buying it on an earn-out basis, and I knew that they were going to be sold in, a few years, because the VC wasn't going in there to, build that company or anything. But so I made it to where if they were sold in 3 years, I didn't have to pay them anything, which was kind of cool. Yeah. But when I'm negotiating this, I sit down in the room and there's 4 Harvard attorneys, and I'm like, guys, this is not that big of a company to take all 4 of you dudes over there to to work this out. Yeah. So to your point, yeah, you better be ready and sharp, because the other side is going to be. I think that the other thing is, okay, somebody writes me a check for, and I know this isn't, I'm just saying this, kind of figuratively. They write me a check for $70 million. And my buddy is with JP Morgan, and he says he's like the high net worth guy, which I smirk at. And so I guess I'll just give him that, whatever it is after taxes, and he'll manage that money for me. And then a year later I go, my money didn't really grow that much. And I don't really even know what's happening with it. He's never explained it to me. I don't really know what my strategy is, and it's a lot of money, right? So talk about the difference between kind of that retail, even if they think it's the high net worth guy, versus having like a family office, and the benefits of doing it really the right way.
Yeah, it's a great observation, and you and I share a similar, I think, distaste for the traditional wealth management industry. One of the reasons why we started our family office was we watched our clients do exactly what you just mentioned and get charged a lot of fees. I also think that, unfortunately, in the wealth management space, there's just a ton ton of conflicts. There's a big incentive for folks to drive their clients into certain funds, which typically have elevated fee structures. And we just looked at it and said, there's got to be a better way to do it. To your point, I think the investment management is important. Don't get me wrong. But for our clients, that's just a piece, I think, of what's important and the true value that we're going to bring. We in your example, right, of the JP Morgans or the, Chases, whatever it is, the average ratio of clients to an advisor is about 60, 60 to 70. Ours is 15. And ours is purposely designed that way so that you can spend a lot of time with the client. You can be proactive. And a lot of it, I think, is about, on the investment side at least, is not necessarily stock picking and trying to do better than the market, because we're certainly not, better than the market. I think it's more trying to manage the psyche of of our client, help them not get too nervous when things are challenging. But we spend a lot of time, where you can achieve superior returns is through great tax planning, tax loss harvesting, doing all of that and being thoughtful about it, which takes some attention. Being thoughtful about asset allocation. And most of our clients are very high net worth. And so helping them evaluate private alternatives. They can withstand the risk of illiquidity over time. And typically those investments are going to have much better yields. And so it's something we spend a lot of time with our clients on. And so I don't disagree with you. I think the traditional wealth management industry is broken. And, we think there's a better way to do it.
I love what you said. I was waiting for you to say the tax strategy because, if you make $5 million a year, it's not really about making $5 million a year. It's how much of it do you get to keep? And
for sure,
that's one of the reasons that I like real estate and businesses is because of the tax strategies that you can implement. And like you said, it's funny, the traditional financial planners, what they do is they want to tell you, well, your average rate of return is X, right? I want to know what my CAGR is, right? I want to know my compound annual growth rate. And forget about what your averages are. And it's like marketing, it's noise. And I like what you said because, you can't recreate this money. And you can't panic. And I have another example is there was a guy that I knew that he sold his business. I think he netted 35 million and put it all very aggressively in the market. And he even bought some annuities. And some big like universal life policies that were supposed to be an investment. And so, somebody's just, I don't know who the advisor was, but it was just maximizing his commission, right? And it was around 2008, 2009. He panics, but he'd also margin that account.
Oh, boy.
So he ended up literally with $2 million.
Oh, my gosh.
Yeah. Now, this is criminal when he tried to sue, but you know what? He signed all the disclosures. He signed everything saying he understood what he was doing. Well, that guy died like 6 years later.
Yeah.
And the stress and the like, oh my gosh, what did I do? Killed him really.
Yeah.
And I think it's so important. And I really like what you're doing. And I'm glad that we had you on the show and that I know somebody to send people to, because I'm telling you, Chris, there's so many people out there. This is serious shit. This is your life. This is money. And if you're fortunate enough to build your business to 50, 70, $100 million, it should be generational, not temporary, and you should be able to impact, hopefully at least 3 generations ahead.
Yeah, I like to say our clients as entrepreneurs have front loaded the risk in their lives in terms of owning a business. It's, as you know, being an entrepreneur is highly risky. And so our job is, hey, once they've gotten, they've harvested the wealth from that business, now our job is to protect it. and make sure that, the example that you gave, which is a horrible one, never happens to them, where, hey, they never have to work again and they don't have to really worry about it. And it does, require some forethought, and it requires risk analysis and all that. But it is I don't disagree with you. I think like I said, I think the traditional wealth management industry is pretty broken. So
Yeah, like anything you want in life, you got to find a guide and somebody that has experience. If I'm going to go climb Mount Everest, I'm hiring the best Sherpa that I can find.
for
Right,
sure.
I'm hiring the best. I don't want somebody. Hey, I think I can get you up there.
Yeah, right.
I mean, so and this is life or death when you are doing this and you're selling your business, and the stress, and like you said, there's a lot of stuff that goes into it. Chris, how would people reach out to you, and how would they learn more about your company and your services?
Sure. So the name of our firm, interesting, you talk about the guide, is called Class 6, Class VI Partners. That's named after the most difficult rapids. So you definitely need a guide, otherwise you're going to die. So
Love it. I love it. I didn't even know there were 6. I think when
yeah,
I've done that, I think it's like 3 or something. But
yeah. So in any event, www.class6partners.com, they can see our website, and I'm Chris at Class 6 Partners, CHRAS at class6partners.com. And we work with a lot of entrepreneurs that we never sign on as clients, and we love to do it just because we love entrepreneurs. So we're happy to support them.
It's funny. I have, we have a community that's Create Tailwind, and maybe down the road we can talk about how Class 6 Partners could build a course that people could, like you said, because we just love to educate people.
Yep.
Business owners, free thinkers, real estate investors, and people that are real estate investors. You're in the real estate business. You're a business owner, not just an investor. But
yep.
I really love to educate people about that. I love business owners too. Even when I was doing fee-based financial planning, my favorite part was getting to know the business owner, how they started the business, how they grew it, and just the stories. And I know you get those stories too, but I love it. I love that somebody is willing to just put their neck out on the line and go for it. And so thinking of that and thinking about all the business owners, I've run across a lot of people that have given me great advice. Chris, obviously you've become very successful in your business, so there had to be some great advice somewhere. What's the best advice anybody's ever given you?
So obviously my dad's given me a lot of great advice. The one piece I would identify as a mentor of mine, his name was Jim Walker. And he always told me, hey, if you think about a sine wave of ups and downs in your life, you want to keep that sine wave, the depths to the heights pretty tight. And I think that's true, is just try not to get too low and try not to get too high, because, for an entrepreneur in particular, there are lots and lots of highs and lows. And if you let that sine wave get too big, it'll destroy you if you're not careful. And so, my dad used to say, "This too shall pass." Right? And that's both true on the good things and the bad things. And so, just being able to keep that the modulation tight.
I like that, because one of the quotes that I like is, "Things are never as good as they seem or as bad as they seem. Reality somewhere in between." And
exactly.
It's basically the same. It's what you just said is,
yep.
Like, don't get too high, don't get too low, just keep it in the middle. And I remember when I signed my first contract to do financial planning, there was a guy that was retiring the same day. And I said, "Hey, what advice do you have for me?" And he said, "Keep your peaks and valleys, close or not extreme." So like, it's just, a lot of good advice, I guess, from all three of those, the quote and that guy and your mentor as well.
Yep.
All right. Chris, if God came down from heaven and only allowed you to retain the knowledge that you've received from one book that you've read, what would that book be?
So I'm a huge fan of Charlie Munger, who was Warren Buffett's business partner. And there's a book called Poor Charlie's Almanac. It's hard to get. but I've given it to all three of my kids and always recommend it. He's just, I love listening to him and love reading his, it's really a compilation of a lot of his talks.
Yeah.
And it is outstanding. Great life advice in there.
I love it. I love that you've given it to your kids. Like one book somebody reminded me of a couple hours ago that I give out to a lot of people is The Go Giver. Have you ever read that?
I haven't, but I like the title.
Okay, so I'm gonna, as my gift to you, I'm gonna send you that book.
Thank you.
I'll get somebody in our organization, because you do not want me sending out anything because it'll never leave. But somebody will send you that book. So I really appreciate, Chris, your time and your attitude about the business. And I can tell you're passionate. I love your the humility part of your book and the relationships, because it kind of reminds me a little bit of that Colorado attitude, which is, I kind of like that in Naples here too, is if you think you have a lot of money, you're in Naples, you're probably not, you're not even close,
Right.
It's like, if you were worth $100 million down here, you're just also ran, you're not in that top 1% for sure. But so humility is something that, because it's not all about money. Wealth and happiness is not all about money. It's about time and being able to do what you want to do when you want to do it. And I hope that every business owner that is listening gets to that point where they can do what they want to do, whether it's going down the rapids or hitting the golf ball or going out on the boat fishing. Life's too short not to have fun. So
for sure.
So thank you so much, Chris, for being on the show. And we're going to end this audience like we do every episode with the incredible words of Earl Nightingale and The Strangest Secret. Take it away, Earl.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Once again, thank you so much for taking the time to hear what was shared on today's podcast. If you are looking to discover new wealth building strategies, then go to community.createtailwind.com. That's community.createtailwind.com to join our free online community and get access to free courses and in-depth training videos designed to help you build wealth and break away from the herd. Click the link in the show notes to access the community today. Thanks again for listening.